We are starting to see perhaps some concerns that oil prices, gas prices, metal prices today remain all on the upside. What does that mean for inflation? We want, therefore, to go to Ed Morse. He is Global Head of Commodities Research for Citigroup. And talk to us first and foremost about the news, oil prices spiking to levels that we haven't seen in years, Ed. The move from OPEC Plus, was it as you anticipated?
It is absolutely not as I expected. I fully expected that they were going to at least double the allocation for November from 400,000 barrels a day to 800,000 barrels a day. Almost every analyst on the planet has a different view from what the OPEC Secretariat has about demand growth in the next 2 months. And certainly the natural gas and electricity crisis that's hitting China and Western Europe at the moment is really part of that. So we do think that they're going to meet again eventually, if not before the month of November, to try to put more oil back in the market because the market is really substantially tighter than they had thought.
I'm curious, too, about the general thinking behind OPEC Plus, and obviously this is going to be more speculation than anything here. But is this them sort of saying we need more time to sort of figure out a supply plan, or is this them basically trying to take advantage of the current market environments to make a little bit more money?
I think it's the latter rather than the former. I think they like higher prices. They don't know how long they're going to last. They have a view that they might last longer than people think. They certainly tend to talk down the likelihood of U.S. shale rebounding. We don't do that at all. We think that the U.S. shale is part of a problem that they will confront next year. We estimate non-OPEC supply, excluding Russia, to be up by over 2 million barrels a day next year.
Ed, Roger, sorry, I just want to interject. On shale, though, do you think that there's a price point where we start to see more of the U.S. shale producers come back online? Because there's been a lot of restraint here, and I think a lot of people were looking at $70 and they were looking at 80 and saying at some point all this is going to restart.
Well, there hasn't been restraint. Certainly, there's been talk of keeping capital spending at a low point, 50%, 60% of cash flow. But if we look at what's happening in the market, private companies have been adding rigs every single week, and the rig count is going up. And we're seeing the publicly traded companies buying up the private companies, and they're doing that with a higher rig count that they hadn't bragged about at the beginning. I think that the companies are getting to the point where they're in a period where they're generating positive cash flow. I think the shareholders of those companies are going to start indicating that at these prices, you've got short cycle material under the ground. It's time to monetize that value and believe that the net present value of your reserves are better off if produced than if held in the ground. So I think we will be seeing a sea change, and just the dynamics of acquisition of smaller companies by bigger ones is going to see the rig count of the bigger ones going up.
Ed, speaking of pricing, what do we make of Brent crude? How much higher can we really see prices go from here? And to what end? Well,
it's very hard to see the top. I would note that at the moment, this increase in prices comes at a time when managed money, the financial community, is very light in liquidity in the market. Not only are they lightly positioned, but the investor community also is relatively light in terms of the ratio of long positioning to short positioning. So if we see a spike in that ratio, if we see a spike in the attitude of the market, we can see a $10 jump overnight with no change in the physical market. Wow. And that's not by any means out of reality. We've seen the forward curve jump by almost exactly the same amount as the prompt price has. We've seen basically a $2 jump in the prompt and a $2 price jump in the deferred. So this is looking much more attractive for investors.
So OPEC Plus isn't as alarmed as the rest of the market is. Steady as they go, therefore oil prices jump higher. I want to understand your view on how bad the gas situation can get in all of this, Ed, because many feeling that, of course, the demand for oil is going to rally as we see diversion away from gas. How much is there a crisis upon us in Europe, and how much worse is it going to get?
Well, the crisis is going to depend on the weather. I would note that at the same time that OPEC has indicated that the world only needs 400,000 barrels a day, a month of new supply, the head of the largest company in OPEC, in the Kingdom of Saudi Arabia, said in the same day that oil demand is up 500,000 barrels a day more because of the gas problem already, and more to come. Gas really depends, and electricity really depends on what the winter weather will be like. If we have a mild weather situation, then they just might get away with it. But look, if you look at the electricity prices in Europe today, they are about 35 euros per megawatt hour. The same megawatt hour price at the beginning of the summer, beginning of June, was 23 euros per megawatt hour. So we've seen a parabolic leap in the price of gas and in the price of electricity in Europe. And it looks as though with bad weather, with the colder weather, we'll have to have a price to being the rationer of demand. And that means a hit on consumption by individuals and a hit by businesses.
Do you anticipate, though, that that will have a dramatic or at least a material push down, I guess, on some manufacturing activity? We've seen a lot of factories either curtail production or in some cases even shut it down completely in Europe as well as in Asia here. And there's concerns that if we do get into this winter weather that everyone's predicting is going to be more severe than what we saw in the previous years, that would just then suck more supply away from some of those factories to more essential heating needs.
Yeah, let me give you one example of that. We talked about other prices going up. Aluminum is veering on the $3,000 a ton mark, and electricity costs at the margin for an aluminum smelter is already over $3,000 a ton. So just the cost pass through is shutting down, major industries that are on the supply chain. And governments, particularly in Europe, like those in China, have a choice of whether they subsidize the employees of those companies, saying that they're going to pay for the companies to shut down in order to make available more electricity for the general public, or whether they're going to let the market determine it, in which case there will be much greater danger of a recession.